The lending process should be pretty smooth and easy. However, it is not. It can be so complicated and overwhelming, makes you want to pull back. But do not pull back. Keep going and move forward and get that home that you want. I'm going to simplify the process as much as I can, talking about FHA loans, conventional loans, the VA loan, as well as the 203 loan that you can get, comparing the 30-year versus a 15-year mortgage. What are the drawbacks and plus and minuses to each one of these different loan types and the terms? As a starter, ensure you have these pre-checklist items. Ensure that your credit score is over 580. I always recommend 650, but if you have a 580 credit score, I'm not going to stop you from moving forward and getting your dream. Definitely go for it. The next thing is pay down as much debts as you can. Start with your short term and the least amount first and work your way to the highest and more longer term debt. So that's your credit card. Start with the one that you owe the least amount and work your way to the one that you owe the most amount to. Your student loan. If you're not a few months away of paying that off, then don't bother. Just write it out. Next is your car payment. If you're not a few months from paying that car payment, don't worry about it either. Just keep writing it out. It will affect things, but it's okay. Next thing, ensure that you're properly managing a monthly budget. If you haven't checked out my managing your monthly budget video, definitely go check it out. And it's your home. It's okay to save less and put more towards the home than try to save as much money as you can while you were renting. It's not the same. The next thing is I recommend to have at least $10,000 available to you at your disposal, because you need money to do things just in case things doesn't go perfectly right. You have to spend a little bit of extra cash. You want to make sure you have some cash available. And $10,000 is a pretty good number to ensure your closing transaction and the whole mortgage process goes smoothly. Okay, so let's start off. What is an FHA loan? It's pretty much a first-time home buyer program that the government regulates. They don't provide the money. The banks still do, but the government regulated to allow people with not that much money to be able to get into a home. So it's a very good program if you're trying to get in the market. It allows you to compete with those who have millions and millions that they're just buying property. So it allows you to get into the housing market with the least amount of money as possible. It only requires a 3.5% down payment for a single family or a multifamily. There are some restrictions if you're getting more than a 3-family unit, but we're not going to get in all the details. Definitely, it's something you should speak to your lender about because those laws regulate. The downside to the FHA program is it comes with private mortgage insurance. So that's pretty much an insurance that you pay, because the way that the government and the banks look at it is, since you're putting a low down payment, you're a risky investor. So if you default on the loan, that mortgage insurance allows the bank to recoup, if not all, most of the money that you are defaulting on. There are loan limits with FHA. However, if you're in a high expensive area such as Los Angeles, California, San Francisco, or New York City, then those limits are much higher because the prices are much higher in these areas. So what FHA has done is it recognized that and lifted those limits higher for those areas. The last thing I want to tell you about the FHA is you can't legally Airbnb an FHA. So definitely, if this is something that you were looking into or trying to get into, definitely talk to an attorney, but legally you can't just Airbnb into an FHA home. Next, we have the 203 loan. The 203 loan is something that works hand to hand with the FHA loan. It pretty much is part of the FHA program. What it allows you to do is renovations and upgrading the home, either before you're in it or in the early stages. If you do the limited one, you can do it while you are in the home. But if you do the standard one, where it's major repairs, usually you cannot live in the home until those repairs are done. So you have to be careful with those. I definitely highly discourage getting the 203 loan because it's a lot more paperwork It's a lot more time consuming. It will take you longer to close. And not all sellers would be willing to wait that long for such lengthy loan process as well. So I highly discourage it. But here are the details of a 203 loan. You have to get a pro contractor who is insured, licensed, as well as willing to go through this lengthy process, because the way they get paid is much different than a standard loan or even giving them cash. And not all lenders offer this program, so always ask your lender if you're something that you're interested in, do you offer a 203 program? And many of them don't, but just something you should be looking for. It also comes with a higher interest rate, meaning if your rate is 4%, the 203 loan might be like 4.75 or even 5%. Now, the plus side is that you can use it to do repairs such as plumbing, electrical, sewage, flooring, your roofing, sidings, things that improve the home for it to be more livable. The limited 203 loan, you can take out up to $35,000 to do those repairs, remodeling. However, the standard one gives you much more flexibility. You can take a much higher loan, but it's much more paperwork, a much lengthier process, and you have to hire a HUD consultant. He is just there to make sure you're not getting screwed by the contractor and making sure you're not doing things that are out of line or out of reach. So if you want to do it, just definitely do your due diligence and research and be ready to spend much more time doing a lot more paperwork and have lots of patience to be able to go through this process. Next, let's look at a conventional loan. It requires the most down payment. However, you save much more because you're not paying private mortgage insurance. It requires a 20% down payment. So meaning if your home is $400,000, you would have to come up with $80,000 down payment. Versus on the FHA where you only need to come up with 3.5 on a $400,000 home, that is $14,000. So big difference there in down payment. You don't have to legally live in the house. This can be purely a rental property. You can rent out the whole thing, and you can even legally Airbnb parts of the house or the entire home if you'd like. You can convert that home into an LLC. You have so much flexibility because you had placed such a large down payment. The government and the bank allows you to do so much more with the home. The last one I'm going to cover is the VA loan. That is limited to veterans or spouses of veterans if they're purchasing a home. So the plus side, no down payment. You do not need a down payment, and you also don't pay private mortgage insurance. Isn't that a beautiful thing? You have all the cash that you save. You can just walk into the home without spending $1 on the down payment. And also you're not paying mortgage insurance. So it's like you have a conventional loan without the down payment. It's just awesome. Now with these 3 loans, only the FHA loan and the VA loan you could do a streamline refinance for. So a streamline refinance is, let's say I purchased the home $400,000 at 4% interest, right? My payment is a lot. Now, let's say a year later, I've been making consistent payments. Now I'm a year into the home. Some regulations allow for, I believe, 7 months or 8 months, but it's usually between 7 months and a year. Once you have made those consistent payments, the bank allows you to do a streamline refinance where you don't have to get an appraisal, a lot less paperwork, and you pretty much refactoring the purchase so that way you can get that lower interest of 3% because rates have dropped, and it makes sense. With the closing fees, you still have to pay some closing fees and bank fees. However, the bank will calculate that for you to see if it makes sense to refinance right there and then, where you don't have to come out $1 out of pocket. And sometimes you even get money back and you get to skip a month of mortgage payments. So it's a great idea to do that within 7-8 months or even up to 12 months after you initially purchased the home. So it's definitely something you should look into if you have been in the home for 7, 8, even 12 months. Talk to your bank and see whether you qualify to do a streamline refinance. The conventional loan does not allow such process. You have to do an entire refinancing where you have to go through the appraisal process. You're pretty much starting over. So that's the drawback to the conventional. All these loans, they don't have an income limit. So if you make $500,000 a year and you want to apply for these loans, you can go right ahead and do them, except for the VA loan where you have to be a veteran. But other than that, there is no income limit and there is no income minimum as well. The income minimum is going to be relatively to the amount that you're trying to purchase. So the higher the purchase, of course, the more you're going to need to make to qualify for that. However, if you make $30,000 a year and homes in the area are like $50,000, you will be able to qualify to purchase a home. So do not fear that because you don't make enough, as they say, enough. You don't know what enough is. It's better you talk to the bank or lender and figure out what is the math of what you're trying to purchase and see if your income and what does your income and assets qualify you for. Here is why 30 years is better than 15 years. If you're debating whether you should do a 30-year loan or 15-year loan, going back to our scenario that we have been using, I'm a single person making $60,000 a year. I'm qualified for a multifamily up to $420,000. Let's say with my closing costs, everything came up to $420,000. I financed it all. Now my monthly payments would be $2,933. So that is based on a 4% interest rate. My property taxes is $6,000 a year, which is $500 a month. My homeowner's insurance is $2,000 a year, which is $167 a month. My private mortgage insurance is $331 a month. And my principal and interest is $1,935. So all in total, I'm paying $2,933 a month. Now let's look at a 15-year. The 15-year, you're going to pay more because you're paying the loan in half the time. So, and your interest drops as well. So instead of 4%, your interest would be somewhere around 3%. Let's use 3% as that number. Same home price, same down payment of $14,700. Your principal and interest would be much higher at $2,799. Your property taxes would be the same, $6,000 a year, which is $500 a month. Your homeowner's insurance would be the same, $2,000 a year, which is $167 a month. And lastly, your private mortgage insurance would be $331. So pretty much the 15-year versus 30-year, everything is the same. The big difference is your interest. Because even after the 15 years, if you do the 15-year, you will still be paying property taxes. You will still be paying the homeowner's insurance, and it might be even higher. So everything stays the same, but the interest is what you're pretty much saving if you do the 15-year versus the 30 years. So let's look at those numbers. The interest that you would pay over the course of the 30-year loan would be a bit over $290,000 for that $420,000 home. If you go with the 15-year, you would be paying a little over $98,000. So you would be saving about $192,000. But let's see why that does not make sense, right? Your monthly payments, you're saving $864 a month if you stick with the 30-year. But if you do the 15-year, for those 15 years, you would not be able to save that $864. Remember how I explained that it's always better to have some cash that you can invest in? Well, this is where it makes sense to do that. Because that $864 a month that you're saving, you could put it into a growth account that just grows over time. If we look at a standard 7% return on your investment a year using the compound calculator, that amount is $276,000. So I've saved over $276,000 versus saving $192,000 over the course of that 15 years. So you see, even though it sounds better, you're able to pay your home much quicker. However, you have money that you could invest and just have it grow over that 15 years, which allows you to save a lot more. I don't know about you, but I'd rather have $276,000 in savings, in cash too. That's available to me because remember those mutual funds, you can pull out money whenever you want. It's just a few days for you to be able to sell all your shares and then just withdraw, versus saving $192,000 that's just stuck inside of the equity of the home, which I can only get by selling. So it's better to have that cash available to you, and it grows much higher than what you would be saving in the home. If we go with even a higher percent of return, let's say 10%, over 15 years, that number is over $360,000. So it all depends on how you're trading, what funds you go into, all these things that can help really grow your money. But it's always better to not do a short-term loan and do a longer-term loan and invest that money elsewhere, because your home has equity, but it doesn't really grow. The equity of it doesn't grow as fast as it does in the market. It fluctuates as well. However, it's just better because you don't have to refinance. You don't have to sell the home to get that equity out. It's always available to you. So it's better that you pay it off across the 30 years versus the 15 years. Thanks for tuning in. I hope this was very informative to you in helping you make that decision of getting that home that you want. If you already have one already and seeking to your next one, I hope this helped you kind of figure out where you should do, what you should be, and figure out what works and doesn't work for you. So please subscribe if you haven't done so already. Drop a comment if you can. Until next time.